Hi, class. I hope you're all getting into the swing of the semester. I just want to go over Chapter 2 with you and do some examples. Hopefully this will help you out. So Chapter 2 is about job order costing. In this chapter, we don't typically cover process costing. That's in Chapter 3, and we actually skip that because I don't think it's pertinent to this class. But we'll just cover job order costing. So job order costing is really just keeping track of unique products or services, like a construction product or project. So it's customized. We have this customized process where every customer might get a different thing. We still need to track costs, and we need to know how much a particular job costs so that we can price the job appropriately. That's the basis for job order costing. Don't forget, your manufacturing cost categories haven't changed. Direct materials, DM, direct labor, DL, MOH for manufacturing overhead. Those are the three manufacturing cost categories. When we assign manufacturing costs to jobs, in other words, we have a job, we've used direct materials, we've used direct labor, and we've used manufacturing overhead. How do we get all of those costs into a job so we know how much that job cost us? We don't want to just combine everything together and not know how much that job cost us. We're going to use an example in the slides that talks about a house flipping. Now, these slides I'm using are somewhat different than the ones that have been uploaded for your use, the entire slide deck. I've picked some out of here, and then I'm going to take this example outside of this PowerPoint and go through it with you and do some explanation. So, how we get direct materials and direct labor to a job cost sheet, and a job cost sheet is simply a place where we accumulate the cost of one single job. We use a materials requisition form and a labor time ticket. And we'll talk about overhead here in a minute. So a materials requisition form might look like this, but more than likely it's probably electronic. So it will give the job number or some description of the job. It'll have a number on the requisition itself because we have to keep track of things. So we don't want to lose something, so they're typically numbered in order. It'll have a date, and it'll list the things that this job is drawing or requiring. So they're obviously doing a tile job here, so it tells how much went out to that job for that tile job, or to this job for the tile in it. Same thing for direct labor. Direct labor, remember, direct materials and direct labor can be traced directly to a job. So that's what we're doing. We're tracing it. So what we're doing is using a timesheet to show how many hours these employees worked on that job. So this particular employee worked on job 27 for a while, did some training, which doesn't get assigned to any job because that's going to be overhead, and also worked on another job. They come into the job cost sheet as the three things: direct materials, direct labor, and manufacturing overhead. Now, how do we know how much manufacturing overhead? We don't really know the exact amount of our manufacturing overhead for the period, which could be a whole year, until the year is finished. But we need to know how much to charge to this job now. We can't wait. This job started in July, and perhaps it's going to finish up before the end of the year. So we can't wait till the end of the year to determine how much overhead this job used. So we apply overhead using a predetermined overhead rate, because we want to get that overhead in there and charge it to the job, and we do this based on an estimate. So predetermined overhead rate is, and I'm not going to read all this to you, but I just want you to understand that It's an allocation of overhead that we have determined through an estimate that we will have at the end of the year. There's a formula to calculate it, and it's important to understand that we're using estimates here. We're taking our estimated total manufacturing overhead costs for the year, and we're dividing it by the cost driver. A cost driver is something that drives that overhead cost. In this chapter, we'll just look at a single overhead driver. So we've determined in the house flipping that direct labor drives the overhead. So the more direct labor we have, the more overhead we have. That's what we mean by driver. It's something that causes that overhead to increase. So we use direct labor hours in the flipping houses business because it's labor intensive. Most of the costs come from labor. So you've estimated the total manufacturing overhead costs for the year to be $150,000. Direct labor hours are estimated to be $10,000. Now, when you do the predetermined overhead rate, you're going to use the estimated total manufacturing overhead divided by the amount of the estimated driver. In this case, we've determined that direct labor hours drives this. Now, sometimes you'll see a dollar amount that drives it, and we'll do an example of that. But in this example, we're saying the more direct labor hours we have, the more overhead we have. So we're going to take our estimated overhead divided by our estimated total direct labor hours. And we come up with $15. It's important when you come up with these predetermined overhead rates to actually label it right away. It's $15 per direct labor hour because we divide it by direct labor hours. So for every single hour we use on the job, we're going to charge $15 in overhead. It's based on estimates. It's determined before the period begins. That rate, the rate that we come up with, is applied using the actual amount of the cost driver. So this is a sticky point, and this is a place where a lot of mistakes are made. When you calculate the rate, you use the estimated amount. So it's estimated over estimated. When you apply the rate, you take the estimated predetermined overhead rate and you multiply it times the actual cost driver. And we'll do some examples of that. Let's do a couple right now. We're going to do mini exercises. And these are in your textbook, but I will also upload this spreadsheet that has the examples in it. Oops, sorry. So we're going to do M2-6, where we calculate estimated overhead rates or predetermined overhead rates. So this company applies manufacturing overcost of products as a percentage of direct labor dollars. So you have to be sure to read what it says in the problem. How do they apply overhead? Then they gave you estimated and actual values. And we're asked to compute the predetermined overhead rate. When we compute it, we're going to use estimated amounts. Sorry, I filled this in, and I didn't mean to. So we're going to take the estimated total overhead, which is $900,000 right here, and we're going to divide it by the estimated direct labor cost. And this is our estimated direct labor cost or direct labor dollars. So when we divide that, we're going to take 900,000 divided by 600,000, and we're going to come up with 150%. 150% of what? So we're going to apply overhead based on the rate of 150% of direct labor dollars. Well, if we were doing it with hours, we'd have an amount per hour. But in this case, it's a dollar amount. Okay, let's do the next problem. M2-7. calculating applied manufacturing overhead. So once we have that rate, what do we do with it? We're working on a job. We have direct materials and direct labor. Now we need overhead. We're going to apply overhead to that job. So using the material from M26, we're going to take that overhead rate. So let's go back here and pick up the overhead rate of 150% of direct labor cost dollars. And then we need to take, to calculate the application of overhead, we need to take this predetermined overhead rate of 150% and multiply it times the actual direct labor cost. So our actual direct labor cost, we're going to look at the actual column now, was $550,000. So $550,000 was our actual direct labor cost. Now we're going to apply overhead at the rate of 150%. So we're going to take 550,000 times 150%, and we're going to come up with $825,000. That's how much we're going to apply to this production or this job. It could be one job, it could be 4 jobs, but that's the rate we're going to use, and we'll apply it based on the actual direct labor costs for each of those. Okay? Let's go back over here. Sorry, I had lost my place. So back over here, we did those examples. We did those 2 examples. Now, how do manufacturing costs flow through the system in a job order costing? Again, using the house flipping example. The company purchases raw materials. It goes into raw materials inventory. That actual direct materials is posted to a work in process inventory. This is where everything that we're working on is. So we've got 3 or 4 houses in construction, then all of the costs will go into there. When the job's completed, it goes to finished goods, and the house is put up for sale, and then when it's sold, it goes to cost of goods sold. Manufacturing overhead is applied to work in process by crediting the manufacturing overhead account. All of the overhead actuals are debited to the manufacturing overhead. So in other words, all throughout the year, anytime there's indirect materials, indirect labor, any of the other actual overhead costs, they get debited to a manufacturing overhead account. It's kind of a holding account. And then as we work on jobs, we apply overhead, because remember, our cost is direct materials, direct labor, and manufacturing overhead. But since we don't really know what the total overhead's going to be, we're going to apply it based on some rate, like we just did in the example. When we apply it, we will credit manufacturing overhead and debit work in process. So then we'll have our 3 costs. And we'll do an example of this. We're going to do this house flipping example. And I have it in here for you. And they actually show this in the other set of slides, but I want to do it here, and I want to walk you through it. Let's see if I can get this. Okay. So I've made T accounts for everything. Raw materials inventory is an asset account, of course, and it's an inventory account. Work in process is also an inventory account. And I'm sorry, I should have actually put that on there. Inventory. Finished goods is an inventory account. Because if you'll remember, when a company makes product, they have three different types of inventory accounts: the raw materials inventory, the work in process inventory, and the finished goods inventory. And then I made a cost of goods sold account. I made this manufacturing overhead account to hold all of our overhead. I made a factory labor account. I made a selling and administrative expense account, a sales revenue account. Now, the thing that I want to point out here is, in this work in process inventory, we could have more than one job. As a matter of fact, in this one, we have two jobs. So we have something called a work in process subsidiary ledger. So within work in process, this total that we'll have in here, there's two different jobs, and they each have their own total. Okay? Let's look at the example. So we assume the house flipping company has two projects going, job 27 and 28. And they have some following information at the beginning of this period. So we need to enter this stuff because this is what we started with. The company started the period with $10,000 worth of raw materials inventory. Okay? So we want to go up here and put that in our T accounts. That's number one. And we started with $10,000. All right. The purchase price of the properties for the two projects were $250,000 and $200,000 respectively, included in beginning work in process. Okay. So this is number two. So we have $450,000 in here. But it's important to note that we need to keep track of these separately as well. So for job 27, we have $250,000. For job 28, it's $200,000. Oops, I guess I need another zero there. $200,000. So together, those equal the $450,000. So we'll want to keep track of this separately as well as all together. All right. The company has two completed but unsold projects in finished goods inventory at a total cost of $600,000. So we have a beginning balance in finished goods inventory, that's number three, of $600,000. So now we have all of our beginning numbers in, and we can begin to look at what's going on now. Record the purchase and issue of materials. The company purchased $25,000 worth of materials. $15,000 was used for job 27 and $10,000 for job 28. Other minor materials of $500,000 were issued and used on both jobs. So let's just take this piece by piece. The company purchased $25,000 worth of materials. This is number four. So $25,000 in inventory. They used some of the material, $15,000 for job 27 and $10,000 for job 28. Those are direct materials because we can trace them directly to those jobs. So 4, and I'm going to put 4 over here as well because it's going to come out of here and go into here. So it's a total of, let's see, how much was it? $25,000 and $15,000. Nope. $15,000 and $10,000. Good. So a total of $25,000 went into work in process. But that was split up for these two projects. So this was the direct materials. For job 27 was $15,000. And the direct materials from number 4 for job 28 was $10,000. So that's our $25,000 here. But it said that They used the 15, the 10, and an additional 500 for minor materials. Oh, minor materials. Remember that? So that goes to overhead. So now we have, coming out of here, $25,500. 25,000 of it went to work in process. 500 of it went to manufacturing overhead. That's 25,500. This 25,000 is split up into two jobs. 10,000 for job 28 and 15,000 for job 27. Okay. Record the labor costs. The company paid $7,500 in labor costs, $4,000 for job 27 and $2,000 for job 28, and $1,500 for the general contractor managing both projects. Oh, so we have a total of $7,500 in labor costs, and this wouldn't be factory labor. This would probably just be labor because it's not a factory. So we can use this account or we can just post it to the proper accounts. And I want to show you using this account. So 7,500 went in here. And 4,000 came out for, oops, what number is this? This is 5. So direct labor, 5. Direct labor, 5. 4,000 for job 27. And 2,000 for job 28. That total here so this was direct materials, this is direct labor. That total here is 4,000 plus 2,000 or 6,000. But there was another little piece here. 1,500 for the general contractor managing both projects. So we have some indirect labor as well that goes to overhead, 1,500. Now, you could have skipped this entirely. As a matter of fact, I think I'm not going to muddy the waters. Let's just take that out. Let's pretend that doesn't exist. We just posted, we debited direct labor, we debited manufacturing overhead, and we would credit the salaries payable or cash, however we paid it. So we'll just leave that out of the mix. I think it's just too confusing at this point. Okay, we have direct materials, direct labor. We still need manufacturing overhead. All right. Record applied manufacturing overhead. We will use direct labor hours as the overhead base. Overhead, so that's what's driving our cost, are the direct labor hours. We estimate total manufacturing overhead for the cost for the year is $150,000, and direct labor hours are estimated to be 10,000. So, $150,000 divided by 10,000 equals what? So we take 150,000 divided by 10,000, and we get 15. That's $15 per direct labor hour. That's how we're going to apply overhead. So down here, it says job 27 had 200 hours and job 28 had 100 hours. Okay. So manufacturing overhead, this is number 6. Job 27 had 200 hours, so plus 200 times the $15 an hour. Job 28 had 100 hours, so plus 100 hours times $15 per hour. Those two together, 3,000 plus 1,500, so 4,500, goes up here in manufacturing overhead, in work in process. Okay? Now we need to record the actual manufacturing overhead. So we had some other things. We had some property taxes, 1,700, some expired insurance premiums for project sites, which means expired means it was used. We have some depreciation on construction tools and equipment. Okay, number 7, we're going to post this to manufacturing overhead, is 1,700. Number 8 is 1,000. Number 9 is 800. So we've posted all of our actual manufacturing overhead. Now we're asked to transfer cost of finished goods inventory and cost of goods sold. So job 27 was finished and sold to a customer for $350,000. Okay. Let's calculate our total costs here. So we started with 450, we added 25,000, we added 6,000, we added 4,500. So we have total costs here of 485,500. It said job 27 was finished. Job 27 has these accumulated costs. $272,000. Job 27 needs to come out of work in process inventory. So $272,000. This is number, what number is this? Oops, I want to put it there. So 272,000, this is number 10. That goes over here into finished goods. $272,000. Now we need to recalculate here because something went out, right? 272,000 went out of work in process. So now our balance is 213,500. We only have one job left. If we did everything correctly, this one job left in here should total up to 213,500. Okay? So this went into finished goods inventory, but it also said it was sold. So we need to move it out of finished goods inventory, $272,000, number 11, into cost of goods sold. Now the balance in our finished goods inventory is going to be 600,000 plus 272,000 minus 272,000, or 600,000. So flow of goods through the system. It was sold to a customer for $350,000. Oh, well, I guess we got to record revenue, right? Sales revenue. This would be, I think it's still 11, isn't it? It's 11, yes. 11, sales revenue, $350,000. Okay? So we sold it. So what about manufacturing overhead? When we applied this manufacturing overhead, we actually took it out of here. And that was number 6. I forgot to post that for you. So number 6, we took $4,500 out of manufacturing overhead and applied it to a job, to 2 jobs, as a matter of fact. What balance does that leave us in here? Okay, well, manufacturing overhead, 500 plus 1,500 plus 1,700 plus 1,000 plus 800 minus 4,500. So did we over apply or under apply? We under applied because we still have some left in here. We applied $4,500. We should have applied $5,500. And that way, this would be 0, right? The total would be 0. So we have to zero out manufacturing overhead by crediting it for $1,000. And this would be number 12. So to do that, we subtract it. That brings our manufacturing overhead to 0. And let's copy this format. So $1,000, we credited manufacturing overhead. That means we have to debit something. So we're going to put it in cost of goods sold. This is the simplest method of dealing with over or under applied, is closing it to cost of goods sold. There's another method that does a ratio and applies it to different accounts, but we won't do that. We're just going to use the simple method of closing it out to cost of goods sold at the end of the period. This makes our total cost of goods sold $273,000. We're still going to show this job cost at $272,000, but on our public financials, we're going to show the extra of $273,000. So we over applied, or we under applied, because it was a debit balance in manufacturing overhead. And we posted the entry to close out manufacturing overhead to cost of goods sold. That's a comprehensive example of how costs flow through the system. You really need to understand the T accounts and how it works, because in the second half of this chapter, we're going to do journal entries. So if you have the T accounts down, journal entries will be much, much easier. Okay, so back to the slides. And they worked this out in the slides. I just wanted to be able to explain to you as we went through what happened. And that's why I took that labor account out, because it doesn't match this. So you can see the flow of costs, the same thing we just did. When you're finished, you create a cost of goods manufactured report. Essentially, we're taking those T accounts and saying beginning raw materials plus what we purchased, less the indirect, less the ending raw materials equals our direct materials used. So direct materials, direct labor, manufacturing overhead applied, those 3 total our current manufacturing costs. If we add our beginning work in process and subtract the ending, it gives us the cost of goods manufactured. And this is based on the applied, not the actual overhead. So if you understand the T accounts, you can do this report, and you will need to do this report. Then we prepare an income statement. Our sales revenue of $350,000. Here's where we look at our finished goods inventory. We started with $600,000. We added $272,000. We subtracted our ending. And here's our unadjusted without that overhead, that under applied overhead. That's the 272. Use this statement and compare it to those T accounts so you understand. Then we add that under applied. Remember, we added $1,000 to cost of goods sold, and we come up with a total cost of goods sold of 273. We had some selling and administrative expenses. Well, hold on, let me not skip this step. So our sales revenue less our cost of goods sold gives us a gross profit. It's important to understand that term, gross profit. And then we had some selling and administrative expenses, which I didn't put in there, but I will put in so you can see it later. And then the net operating income. So sales revenue minus cost of goods sold is gross profit, minus selling and administrative is net income, operating income. And that's it for this chapter. Hope this helped. If you have questions, post in the discussion. I will be monitoring it as usual.